Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. Well, listen, I got news. That GDP print you saw on Friday, that was anything but hot. That was lackluster. We'll break that down, what it means for you, what it means for your money. And then you're already feeling it. It was once again confirmed. The Federal Reserve preferred measure of inflation. Yep. We're running back at 2.9% year over year. So much for that 2% target everyone was clinging on to for the last 5 years. And there's a whole bunch more. Listen, we come to you every Sunday because you need sincere and actionable ideas that can help you improve the lives of yourself and your loved ones financially. After all, we talked about a couple weeks ago, there's a retirement crisis in America. You've seen the numbers. How many people who retired are now going back to work some 5-6 years later, just since 2020? It's absolutely awful. So what do you need to do to future-proof yourself and future-proof your loved ones? That's what we're all about. Give us a buzz at 833-964-PLAN. That's 833-964-PLAN. Go out to our website at getretiredstayretired.com. Well, David, I don't know. I've been betting the over on this economy for a long time, but that GDP, shoot, that came in super low. What are we talking? 1.4% for the fourth quarter? Wait a second. I thought we were going to get 2.5. That's almost half of what we wanted. What's your thoughts on it?
Well, I was thinking 1.9, but regardless, the number's lower than everybody thought. And so I think we pile on some more bad news in the near future because you couple that with some difficulties in the software and technology markets. I think this market needed a breather and we're finally getting it. Does it look like it's Armageddon? Not right now. I mean, the market's held up. But I would say you're starting to see some rotations happen. And I think this is the market trying to reweigh itself as we move into 2026 and broaden out to some other sectors finally. So it's not just a handful of stocks driving the market. And hopefully we get some acceleration in economic growth in the second quarter. But like you said, not the number anybody was looking at. We'll see how it goes.
Absolutely. So, hey, part number one, here's your takeaway. You heard it from David. This is not a deterioration in the economy. This is a moderation in the economy. Let me make that differential. This is not a deterioration. This is a moderation. Part number two, you have to remember this was GDP we're talking about that came in super soft, 1.4%. I got news. That was the fourth quarter. How long was this stupid government shut down? Like half of the fourth quarter. So listen, without that government open, that's reflected in these numbers. And that's the reason Wall Street hasn't been too worried about it. Now, I turn my head to something else that's incredibly important. And of course, we will talk about SCOTUS's decision on tariffs. That's to come, information you can't afford to lose. But David, this affordability thing, oh man, I'm tired of everyone talking about it, but I know how real it is. Dave, a 2.9% inflation print, not what anybody wanted, but I think it's more along the lines of what everyone expected because it's expensive out there. Wait a second. Speaking of expensive, aren't you redoing a kitchen? How's that going?
Well, we haven't started because I'm still in sticker shock with some of these prices. The last time we did anything to our house was 5 or 6 years ago. And I thought that was reasonable. This is unreasonable. So we're still working out the details. But look, we talk about in the office the big CPI lie, as some people have phrased it. And what we're referring to is the things that retirees spend money on. Those inflation rates have been double digits. What we're talking about is, the overall number that we look at. So are we surprised? No. You saw the Fed, right? They're arguing about it, right? There's dissent, right? So we clearly know that some people want to cut rates to stimulate the housing market, but the rest of the people are still worried that this darn inflation is going to be so stubborn. But I think this drives home the point that this is why we invest through retirement, not to retirement, because no matter what, everything that you purchase, whether it's gasoline, other forms of energy, any type of utility bills, that stuff's going to keep getting more expensive. Heck, I just found out the other day I was paying for Paramount Plus 3 times, once on my credit card, once on my wife's, and once on our Xfinity bill. So that stuff starts to creep up and it becomes a problem.
And you know how that happened to you. That was you trying to watch those U.S. men's national team soccer games, right? You ended up with 3 subscriptions. Now, at any rate, here's what we got to do, David. We got to turn this into discernible action. So, David, based off this GDP print, which I take with a grain of salt, came in low because of the government shutdown, based on the fact that inflation's running hotter, what are we advising clients to be doing right now in the here and now? Remember, as goes January, so goes the year. Well, at least that's the old saying since 1950, but that doesn't mean there's any room for complacency. So, David, what do you think people should be doing in the wake of an economy that's not deteriorating, but an economy that is moderating?
Yeah, it's a mixed bag economy. I think, the first part is you got to take a step back and just say, phew, it's been a good several years, despite sentiment numbers being so poor, right? We talk about it all the time. People feel just like they felt during the 2008 financial crisis, but clearly the stock markets have done well the last handful of years. I would say take a step back and just say, hey, things have worked out all right, but is now the time to start recalibrating and figuring out what our retirement cash flow is going to look like. And I think when I say recalibration, what I think about is, number one, changing the allocation. So the asset allocation, what we're invested in. It could have to do with de-risking certain strategies, and it could have to do with preparing for future taxable events. I think all of those things fall under my umbrella of recalibrating. So this isn't, hey, the market's at its top, we need to go ahead and sell and sit in cash. But I think what we're starting to see is, despite good earnings for a lot of companies, the stocks did not perform. But now you're starting to see some of the stocks that kind of underwhelmed the last couple of years come to the forefront. So this rotation is coming through. And if you're heavily concentrated in one area, I think, without a doubt, 2026 is the beginning of kind of reglobalizing portfolios and being ultra diversified, where the last 15 years, we know you didn't really need to be super diversified to make money. I think moving forward, though, that's a really important concept that needs to be reevaluated.
David, you can always feel free to be blunt. Remember, the audience of this station, the audience of people on Salem, everybody is like us. They are information junkies. We love to learn. And I think your being blunt was, hey, owning the S&P 500 seemed like the only game in town for more than a decade. But now everyone is waking up to the reality that just like there's been lost decades in the past for the S&P 500, especially when the asymmetrical risk gets too much, you need to start building this globally diversified multi-asset class portfolios. And we're going to talk more about exactly what that means. But the bottom line is, David, you said it and you said it well. That GDP print, everybody, came in soft. That inflation print came in a little hotter than the Federal Reserve would want for those rate cuts we all desperately are hoping we get. You got to be broadening your investment discipline this year if you don't want to get left behind. I want clients, I want investors all around this country to have a four-peat. That's a fourth good year. But if you're going to do it, you're going to have to follow our 6 for 26. That's 6 action items to put you in a position to win for 2026. We're going to talk about those later in the show. David, give us a hint as to what you're talking about succinctly with clients in light of the fact that the inflation doesn't seem to be breaking. What is that signal to you, and what does it mean has to be done in someone's retirement plan?
We still have to find ways to grow income. So I think one of the things that's come up with more frequency lately is rotating some profits out of the growthier parts of the market, which we still love long term, aka technology and things like that, and rotating some of those profits into companies that have slightly higher dividend yields that are growing their dividends, right? I talked about the market broadening out. That's a good thing. So I don't think that the fact that maybe tech has struggled over the last 60 days is necessarily a bad thing. I certainly want tech to do well. We need it to do well to pull up the indexes. But I think what we're seeing is taking some chips off the table, not getting out of the market, rotating into sectors of the market that maybe have underwhelmed the last 5 years. We pick up a little bit of dividend income, and we pick up that dividend income not stretching for high dividend yielders, but we pick up dividend yielders where companies have a demonstrated history of growing their cash flow. That's our inflation hedge. It helps us not get too concentrated in one sector, and then we're making progress, right? And we want to do that when the market's up.
So you need some thought leadership. We have it for you. I want you to go out to our website, getretiredstayretired.com. What could be easier than that? Getretiredstayretired.com. When you're there, I want you to download for free our Investment Outlook 26. Download for free our Investment Outlook 2026 at getretiredstayretired.com. When we come back, we're going to tee up how you turn this into discernible action. Because remember, your wealth plan, this is not just an intelligence business. This is an implementation business. Our 6 for 26, that's coming up next. You can't afford to miss it. Craig and David in the know, VestGen Wealth Partners on AM 560. The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
GetRetiredStayRetired.com. GetRetiredStayRetired.com. Download today for free that Investment Outlook 2026. This is hard-hitting, good information that allows you to see what we're doing, why we're doing it, because we want you to thrive, not just survive in retirement. David, we always catch up. We always create catchy slogans. So here we go on our 6 for 26. Number 1, buy the dip and sell the rip. Wait a second. Buy the dip, sell the rip. That sounds like trader mentality. What do we mean at VestGen Wealth Partners when number 1 on our list for 2026 is buy the dip, sell the rip?
You're right. We're long-term investors, so we aren't day trading. But the way I think about it is being active amongst a very complex economic and stock market backdrop. And the phrase I like to use is, time to repair the roof is when the sun is shining. Meaning, if you're going to change your portfolio, better to do it when the market's trading near its all-time highs, as opposed to doing it when we have the next market downdraft. But I think the key is in any market, there's always going to be some losing stocks and some losing sectors. And when we get larger bouts of volatility, like we got in 2025, or some people expect us to have in 2026, I think this is our way of telling people, hey, you might get some good opportunities if you're paying attention to rotate money out of something that's worked well into something that's struggled. And if we think about that as an example, I'm not suggesting this as an investment strategy, but there's been something in the news, Craig, recently called the SaaS apocalypse, which references the tough time that a lot of software companies have had as people are concerned that AI is going to, I guess, impede their business models. Those stocks are now trading at the same valuations they were trading almost 12 years ago. So for folks that are looking for something that's on sale, right? Now, we don't ever want to be first on something. You don't want to catch a falling knife. That stuff could keep falling. But I think that's a good example that while the overall indexes have stayed pretty stable, there's always going to be pockets of the market that might underperform. And if you're a little bit active, perhaps you can use some of that volatility to your advantage as you try to restructure your portfolio moving forward.
David, you said it incredibly well. Number one on that list, buy the dip, sell the rip. You gotta stay active amid the complexity. You're gonna have to stay more active than you might be accustomed to with your investments in 2026 to drive results. Number two on our list is going global. You listen to us every Sunday. You've heard us preaching this for months now, but we're making the proclamation. International stocks outperform U.S. stocks for the second year in a row. And that means this is going to be the first time you've got a back-to-back win for foreign stocks versus domestic in what feels like 14.6 years. 15 years. That's a very, very long period of time. And this, of course, is being ushered in by a confluence of things. I mean, number one, it's the asset rotation beneath the surface in U.S. cap-weighted indices that David just mentioned. Number two, it's the massive move in the dollar index that we've seen since Liberation Day in April of next year. And everybody knows de-dollarization is not a fad. De-dollarization is a trend. I don't want it. You don't like it. I don't think it's deserved, but I understand why other people want to diversify their currency. I understand why people want to not have too much U.S. influence on their policies when those countries are too dollar denominated. So you take that and you add to it number three, when we're talking about going global, which is 15 times earnings, is cheaper than 22 times earnings. Now, that doesn't mean just because something is cheap, it has value, but investors are starting to wake up to this rotation. Investors are starting to look for lower valuation securities, and that's going to lead you abroad. But more important than anything, you just have to remember, if history's our guide, and it might just be the only guide we have, there are these long-term secular trends that tend to play out. And typically we go through periods, and they last roughly 8 years. Just remember that number, roughly 8 years, where U.S. will outperform international for investors, or foreign will outperform U.S. for investors. Well, the last trend was 14.6 years. This new trend, if it really is afoot, as I believe it might be, you're just at the infancy stage. So what are you doing to go global? And that's why it's number two on our 6 for 26. Speaking of which, if you want to learn more, go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Download for free today our Investment Outlook 2026 publication, so you too can be in the know with what you need to be doing in order to thrive, not just survive in retirement. So, David, we talked about being more active amid the complexity. We talked about being global. Help me understand the shifting paradigm for portfolio construction, exploring alternative dimensions and markets. Maybe there's a reason President Trump is opening those up for retirement investors across the globe. But tell us about how this isn't necessarily, it's not a new asset class. It's just different ways of giving people access.
That's right. I mean, a lot of these, when we talk private markets, a lot of these investments have been available. Whether or not they were available to retail investors is a different story. But I think the most important thing is the structure of these investments today is, in my opinion, a lot better than it has been. Now, there's a learning curve. And when we say non-traditional investments, that means different things to different people. And I think that's the really great thing about investing is you can invest with your values, with what you want to do. And so that can be things like we talk about all the time, like investing in infrastructure, hard assets, the picks and shovels of AI. It could also mean embracing real assets, commodities exposure. It could also mean embracing things like covered call strategies or buffered notes. Things that are going to act maybe a little bit different than the stock and bond market. And if you're out there thinking, hey, I've done well the last 3 years. I'm very comfortable where we're at financially, and I might want something in my account to potentially zig when everything else zags. Then I think this is a great year to start learning about these different opportunity sets and get with a firm, not a person, a firm that has a long history of utilizing all these different types of investments so that you can align your portfolio with your values.
David, I think that's so incredibly important. That's why number 3 on our list of 6 for 26, if you're just joining, this is our 6 investment thematics that you need to consider deploying in 2026 if you want to have a 4P, that's a 4th year of good results in your portfolio. And this is exploring the private marketplace. I mean, after all, the number of public companies and opportunities continues to shrink. Everything is private. And as David said, and I think he articulated it once again very well, you don't need to be investing in using alternatives for risk. You can use them for risk reduction. You don't have to invest in startup companies and angel investing. You can be a lender to companies. You can be a landlord to companies. You can own essential services like infrastructure and energy production and communications, because everybody knows the information has got to get from the data centers to the rest of the world. And how does that happen? Fiber optic networks, cell towers, satellites. And I've got news. So many of those companies that work in that space, they are not publicly traded. They are privately held.
All right, number 4, quality takes the gold, focusing on attractive PE ratios, high return on equity. We talked about market rotation earlier in the show, Craig. This is a great example. Sometimes people talk about bubbles in artificial intelligence. And while we haven't seen a bubble burst in big technology stocks, in the 4th quarter of 2025, we did see a lot of companies, newer companies that are tied to artificial intelligence start to roll over and have massive losses in Q4. Why is that? Those companies, the whole investment thesis was they will be very relevant 5 to 10 years down the road. But then when people started looking at the numbers, they're thinking to themselves, wait a minute, a lot of these companies don't even turn a profit now. They're leveraged, right? They're borrowing money. The market has started to punish those companies. So I think quality takes the gold. And what we mean by that is companies that are consistent with their earnings growth, high return on equity, companies that are demonstrating it today, not just companies that could be profitable in the future.
Absolutely. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Based on the number of Americans that are going back to work, I don't want that to be you. That is a real stat. All these retired Americans who are forced to go back to work because their portfolio didn't provide the returns they needed to get retired and stay retired, probably because they didn't have an effective wealth management plan. Now, we'll talk more about what that means in a bit, but when you're at getretiredstayretired.com, download our Investment Outlook 2026 for free. More on our 6 action items for 26 when we come back. Craig and David in the know, AM 560.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
So we've been talking about the 6 action items for 2026, our 6 thematics. And number 1, buy the dip, sell the rip. Staying active amid the complexity is more important than ever from your investment doctrine. And number 2, yep, you gotta go global. Go global. Number 3, there's that shifting paradigm for portfolio construction. So exploring alternative dimensions in private markets It just makes sense, and you need and should want to get educated. And number 4, sure, it's a play on the Olympics. I'm happy with how well our champions are doing out there in Italy. But number 4, quality takes the cold, quality takes the gold. Focus on the attractive price to free cash flow. Focus on those cash cow companies. It's a great way to invest. But David, that brings us to number 5 on our list of 6 for 26. Bolster cash reserves, staying retired and dry powder. David is a practitioner and you work with clients all across this country. When you talk about your cash flow reserve accounts, how are those used in a retirement plan to help people thrive in retirement? And what do you mean by having dry powder available? I seem to think that that's linked to number 1 on our 6 for 26 of staying more active this year.
Yeah, well, I'll take those in reverse order. Dry powder means being ready to take advantage of maybe some price inefficiencies, some opportunities. So perhaps there's some stocks or there's some ETFs that you like that get really cheap later this year. Well, if you want to execute on that, you need to have some dry powder, and you can, earn a reasonable interest rate in money market or ultra short bonds. Hold on to that cash and wait for that opportunity to strike. But I think the way I'm thinking about it is as people recalibrate, level up portfolios this year, when they're rebalancing, they're also going to carve off some money for a rainy day. And as we execute distribution strategies with clients, right, there's a set amount of money that we're distributing for many families every month, $2,000 a month, $5,000 a month, $8,000 a month. The conversation that we're having in the conference room is how many months of safe capital do you want to have on reserves just in case something happens? What if the market goes down and it doesn't come immediately back up and we stay at depressed prices for a year or two? We want to make sure that we're never forced to sell any of the equity portions of our accounts at depressed prices. And the only way that you can do that is to make sure we have clear line of sight as to where these monthly distributions are going to come from every month. And for certain families, they might want 18 months of cash reserves. Other folks might want 3 years. Other people might want 5 years. It's your money, so we need to figure out the plan together. But having those cash reserves allows the rest of your portfolio to participate in these great companies of America, to compound that growth, to keep up with inflation. But the only way that you can have equities in your portfolio is to make sure you have a plan to cash flow your retirements over the next several years.
Get retired, stayretired.com. That's getretired, Download our Investment Outlook 2026 publication today. David, the challenge is net interest margin, generating interest on cash flow reserve accounts. I get it. There's a price people pay to have a sleep at night portfolio. What are we doing at VestGen Wealth Partners to solve for interest rates that are continuing to go lower?
We talked about it last year, that it was last call on CDs. Well, it was also, in certain cases, last call on certain types of bonds. But the way that you hedge out potentially declining interest rates is you simply build a ladder or a staggered strategy of individual securities that will mature over the next several years. That way you lock in reasonable interest rates, and that way you have clear line of sight so that you can see the maturity dates on your statement, so you know exactly where your cash flow is going to come from. So I get it. Money markets and CDs used to be paying much higher rates. Those rates have declined over the last year. There's a chance they continue to decline. So push out your maturity dates a little bit, lock in what you can now, and create that stability and ballast in your portfolio so that you can continue to be an equity investor with the rest of your capital.
Absolutely. So listen, you need to learn about asset backed. You need to learn about agency. You need to learn about ultra short term gov. You need to learn about all these strategies, because the difference between having a 3% money market and 4.7, that's a big yield spread, and you too deserve to capture it. It's the small things that make the difference. It's about winning at the margins. Make sure you have those cash flow reserve accounts up and moving. Number 6 of 26, we've been talking about the 6 core investments, 6 core strategies that people need to use. I don't know if this is a strategy as much as it is an observation, and that observation then leads to a hypothesis. That hypothesis then leads to policy, and then it leads to implementation. But number 6 on our list of 6 for 26 is that returns come back down to earth. That doesn't mean broad-based markets decline. It does mean, though, that when you start a year with elevated PEs and you remain dependent on assistance from the Fed, you remain dependent on fiscal stimulus, well, you just got to acknowledge that growth is only going to come from earnings. There isn't going to be multiple expansion. It's unlikely to have that occur with PEs where they are in the United States. So, David, with returns coming back down to earth, how do you explain that to a client of VestGen Wealth Partners? And then I think you've already covered it, but succinctly, how are we solving for it?
Yeah, I mean, to me, there's no explanation needed, because if we're honest and we look at the numbers for the last several years, everybody knows that, we had some outsized performance due to some unique economic decisions and political decisions that have happened. But if we use history as our guide, because it's our only guide, we know that year 2 of the cycle, the presidential cycle, tends to have the most moderate returns and tends to be the most volatile. I mean, the average drawdown in year 2 is about 17.5%. The average return is still positive, but you can count that return on one hand instead of 2 hands. So does that mean run for the hills? No, it means reset expectation, embrace some other opportunities in investing, and make sure you have enough cash reserves so that if we do get a larger downdraft in the market and you want to be a buyer, you set yourself up to take advantage of that opportunity. That's what it's about. And I think it's about not being complacent. We said complacency is the enemy of success last year. I would say complacency is the enemy. And also, I think not worrying about some of the small details. Now, that's our job at VestGen, is to worry about those details, to generate a slightly higher interest rate on investments, to educate people about some of these newer opportunity sets. And then, as you say, Craig, all the time, we actually have to implement those ideas, not just talk about them.
That's right. This is an implementation business. This is an execution business. And that's why you can't go it alone. And that's why you can't work with a solo advisor. You need to work with a team. You need to work with a team of advisors all coming together under one roof. That's a multidisciplinary team in investments under a fiduciary standard, financial planning and cash flow modeling under the CFP standard of care, making sure you have estate, legal, tax, retiree healthcare, all of these things in one coordinated, integrated approach. That is the hallmark of a multifamily office. That starts to become the VestGen Wealth Partners difference, but it's also about access, because you need to work with firms that have access. You need access to private markets. We have it. You need access to all of the solutions that are out there with true custodial partners. We have it. You need access to talent, and together we can build a collaborative strategy that's going to help you get retired, stay retired, so you too can worry less, which allows you to live more and pursue everything that you've worked your entire life for. It's time. Go out to our website, getretired.stay-retired.com. Take advantage of that complimentary consultation. Meet with myself, meet with David. Let's make 2026 great. More to come. Craig and David, VestGen Wealth Partners, in the know, AM 560, The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
So David and I were talking on break, and part of what makes the current president so unique but so engaging is how blunt and succinct he is. And he just says it the way he wants to say it. And I'm going to say this now. If you find yourself on a Sunday morning believing that you haven't made the money you deserve to make in your portfolio over the last handful of years, call us, because you deserve strong, competitive, risk-adjusted returns that are in line with your retirement plan so you too can be thriving. 833-964-PLAN. That's 833-964-PLAN. Get retired, stayretired.com. Number two, when was the last time your existing financial advisor actually worked hand in hand with your CPA on what you can be doing to take advantage of everything that was passed in the Tax Cut and Jobs Act and everything that's currently in the One Big Beautiful Bill Act? Has that happened? Because you probably want it to happen. We make it happen. Call us. Go to our website, getretiredstayretired.com. David, the third thing you scratched in the break room while I got an unsweetened iced tea had to do with something tangible. What was that?
Yeah, having a tangible plan. Someone asked me last week and they said, who do you normally work with at VestGen? What's your client profile? And the way I explained that to them was I said, look, almost every family we engage with is directionally correct. They've done a good job saving money. They've tried to be mindful of the income taxes to the extent that they could be. They may have already even had the opportunity to put pen to paper and draft estate documents. And quite frankly, most of them have come to us. They've already had financial advisors. But I think the missing piece, as investors out there are just getting smarter and they're more on top of things, they recognize that retirement is the intersection of all of those things coming together at one time. It's the investments, it's the tax strategy, the estate plan, Social Security, claiming strategies, retiree healthcare, which has been more challenging now for people that are retiring prior to 65. And they're looking for a team of people to help advocate to create synergy amongst all of those different topics. It's not an investment thing, right? That's a commoditized business, but it's coupling that with the actual strategy. And I would say the one thing that I find with most families we end up engaging with is they're just looking for help building out what that plan looks like. And plans come in different shapes and sizes. Sometimes it's 30 pages of Excel or Quicken sheets and cash flow modeling. And sometimes it's just 5 pages that says, when I retire, here's where the money's coming from. Here's how it's going to flow through my 1040, my tax return. And ultimately, here's how it's going to be inherited by my children and grandchildren. And based off of those factors, here's how we're going to reverse engineer the investments. But I think that's the missing component. When markets are going up, rarely do people think about their plans. When markets are going down, that's where they get a little bit nervous. And I think my call to action for everybody listening today is the markets are still up. We've had a little bit of volatility, but we're in striking distance of the all-time highs again. And if you find yourself in a position where you say, hey, I feel like I'm pretty good, but I need help maybe starting to put the puzzle pieces together, then I would say give us a call.
833-964-PLAN. 833-964-PLAN. PLAN. That's the number. Let us help you put the puzzle pieces together. And some of those puzzle pieces are about future proofing. What are we doing to hedge your currency? De-dollarization. What are we doing to hedge out your future income tax risk? What are we doing to hedge out your long-term care, continuity of care risks? What are we doing to protect the ones that you love the most? And how are we eventually putting the ones you love in a position to be successful with the treasure and the legacy that you're going to leave them? Go out to that website, getretiredstayretired.com, getretiredstayretired.com. Download for free today our Investment Outlook 2026. It's chock full of great information. Now, David, as we talk about this multidisciplinary experience, why is it, in your opinion, and feel free to be blunt, and I'll chime in too, that once someone's on the cusp of or getting retired, they can't afford to go alone anymore with a solo advisor? Why is that model broken, and why do they need to hire a multidisciplinary team?
I just don't believe there's capacity for one or two people to do that, right? I mean, that's not to say that, you're not going to find a great attorney out there. That's not to say that you're not going to find a great CPA or a great investment advisor. But if those people don't ever have conversations, then we know there's going to be things that slip through the cracks. And what I found, and this is coming directly from the families that we work with, it makes things easier when the financial planner, the investment advisor, are actually sitting in the conference room with the estate planning attorney. And so all parties can have a discussion so that nothing gets missed. And also, I think, it's not like people do estate planning all the time. You do estate planning 2 to 3 times in your life. Maybe once when you have young children, once in conjunction with retirement when your assets have grown, and maybe one other time after that. This is an endeavor in education, and sometimes people just need help, and we need to explain things in different ways. And once people are armed with the information, they typically make great decisions. But I think what people are looking for today is, I want to make one single phone call to get everything answered. And the person that picks up the phone might not have the answer, but they can put you on hold and say, I know who does have the answer. And you don't have to make 5 different phone calls to 5 different people. You want that single hub, so there is a continuity of care. Ultimately, that's what people hire us for. We represent their family, not just them. And they want that continuity of care because they want a team of people that's all worked together for several decades, creating a family environment, but also providing institutional access to the most complex strategies and breaking those down in simple terms so that everybody can benefit.
And let's be sincere about something too. You need continuity in your advisor. If you're going to plan on getting retired and staying retired, which you can, should, and deserve to do, that retirement, I hope it lasts 20 or 30 years. If you're going it alone with a solo advisor, that solo advisor is probably going to retire during that time period. So not only are you working with a multidisciplinary firm, you're working with a firm at VestGen Wealth Partners that has teams that are multi-generational. Those of us in our 50s, those in their 40s, those who are in their 20s, all on one integrated team to provide the vertical of services throughout your retirement, or not just to you, but to your adult kids and grandchildren. That's what's been built. That's what I invite you to explore. That's what you've been looking for. It's the difference that you've been missing. 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Download some of our publications like Investment Outlook 2026 for free. Connect with us for a complimentary strategy session. Request when you put it in. David or myself will visit with you personally and understand what it is that's important about money to you and your family today. Understand the drivers, and then together we'll work through a collaborative process to make 2026 great. 833-964-PLAN. That's 833-964-PLAN. Get retired, stay retired.com. All right, more to come. You've been listening to who? Craig and David Bolanos. In the Know Radio with VestGen Wealth Partners on none other than AM 560. We call it The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
You know, I got to tell you, I think it's good to know the personalities behind the mic, right? This show started with myself and Leslie for more than a decade. Leslie, my best friend in life, known as my wife, right? And David's come into the foray. David, what got you into the business of wealth management? What drove you? What gets you up out of bed every single day with passion and vigor to do the work that you do to help people thrive, not just survive across this country in retirement?
For me, it's providing access to a set of standards and opportunity set that I feel like is not available to the masses. And what I mean by that is a lot of folks that we work with, and we work with people all across the United States, high net worth business owners, but we also work with a tremendous amount of people that I call like the millionaires next door, the folks that just did it the old fashioned way, sweat equity. They just put money in their 401ks, they've saved, they just put their heads down for 30 years. And I think a lot of those people have outgrown the big box brokers who just say, here's an investment portfolio that's cookie cutter, good luck, call me if you have more money to invest, but that's where the relationship ends. And I think part of what gets me up out of bed every day with passion and vigor is to help those families that have really created what I call like first generation wealth or second generation of wealth. And they're saying, wow, I have an opportunity to actually create this momentum for my kids and my grandchildren. And the way you do that is not through some super sophisticated product. You do that through a process, and that process is financial planning. And that's what we deliver. And it's on those 4 topics. It's the investments aligned with the taxes, aligned with the estate plan, and actually being open to modifying those plans as the environment changes. That's what gets me motivated. We can't do that for everybody that calls us, but we can do that for a lot of families that I feel like have hit that next level and are starting to recognize there is a higher level of service available. And that's what we provide at VestGen.
You're ready for a higher level of care. You've known it. It's time. That time is now. Not next week, not next month, not next year. Now. Seize control. Commit to do better. 833-964-PLAN. Go out to that website, getretiredstayretired.com, getretiredstayretired.com. Craig and David, In the Know Radio, VestGen Wealth Partners, AM 560, The Answer.